Hi, and welcome to the end of June update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require less than one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to concepts in this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we'll continue our series on the Busy Doctor's Update. And since it's June, we're doing the half-year review of all of our systems, including the 20-month moving average system, including the Sector Surfer StormGuard version, the MRI system, including the Sector Surfer variation, remind ourselves of the 25% stop loss system, monitor the free Sector Surfer strategy that's included with Sector Surfer, and then update the Dalio All Seasons pie chart that we've been following for the last couple of years. So, a day in the life of the busy doctor. Just because I semi-retired 4 years ago, life continues to be busy. We're still missing a chief of nuclear medicine at UIC, so I'm still working more days than not over there. Again, anyone happens to know any double-boarded radiologist, nuclear physician who would love to have a chief of department job, feel free to drop me a line, drop UIC a line. But having said all that, remember from my November video about life balance. So this past month I was able to go visit my brother and his family in California with my son. He just had a newborn, so it was great seeing the new nephew. My parents just moved there, so it was great seeing the whole family together. And probably because I'm semi-retired, I'm lucky enough to be able to do something like this more often. But it's just a matter of being mindful of what life is all about, why we do things versus how we do things. Sometimes it's so easy to just get caught up in the how of life that we miss out on the why of life. And then, of course, despite the busyness, I still place trades indicated by my system religiously. They literally require mere minutes to see and execute. And the good news is, this month we still don't have a signal. So, despite my lateness getting this video out this month, for all the number crunching, we're not missing out. So just to review, this I first covered in the November 2016 video, but it's worth revisiting. Okay, when we think about life balance, we usually think about work and family, or work and personal life. But actually, there are several factors that contribute to balance of life. So besides work, career, mission, and relationships such as with family, there's finances, there's time management, there's physical body, something that a lot of us tend to ignore, emotion, meaning, and then of course celebration and contribution, which I'm finding out more and more is a very important part of life. Oftentimes when people fill this out, giving themselves a rating from 1 to 10 on each of these concepts, it can become a very lopsided wheel. It's not only reminding ourselves where we tend to be weakest in, but it also tends to remind us if we're very strong in certain areas, we can afford to not work on those areas as much to try to balance out this entire wheel. And then of course, wheels, we also have a certain hierarchy which we place these particular slices of our lives. So now let's review our systems. Remember, our systems objectively look at the footprints of every trader and investor in the markets, because even though news can lie to us, CEOs can lie to us intentionally or not, pundits can lie to us, newsletters can lie to us, or just be clueless, even financial statements can be misleading. The one place where we have raw data that's the most artifact-free are the direct trades that every single trader investor makes in the markets. Each trade leaves its footprints in the market chart. So when we look at the market chart, we can let the markets tell us what to do when we apply our systems. So the first system is our 20-month simple moving average system. I abbreviate the 20-month SMA. So the rules are pretty simple. if the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if you watch every month. And here's a graphical representation of what I'm saying. All we're doing is looking at two numbers. The Vanguard S&P 500 index fund, you can use any fund that you want that tracks S&P 500 index, and then its corresponding simple moving average. This graph is just a graph to show you the relationship between the two, but honestly, all you really need are these two numbers. If one is above the other, it's safe to be in stocks. If this number is below this number, then it's dangerous to be in stocks and we should get out. So right now, again, you don't need to do this calculation, but it's nice to know that we can drop up to 11.6% by next month and still be relatively safe to be in the markets. So all these little wiggles that you see in the markets every day, every month, they don't mean anything unless it actually breaks our barrier. In other words, if it meets criteria to switch, then we switch. Meanwhile, don't worry about it. So here are the observations for the month so far. The 20-month moving average continues to signal relative safety in the U.S. stock market. Both the S&P 500 index and the 20-month moving average have increased, although the margin has somewhat decreased from 12.7% last month to 11.6%. Now, this decrease does not mean that the markets are decreasing. No, in fact, the market's increase is just that the moving average has increased a little bit faster. It makes sense because lately the markets have been on a tear. So this system is not designed to catch peaks. We're not getting out now because it may still go up, but it must go down at least a little bit enough for us to catch that there's a major trend change before we signal a danger zone. So here's Sector Server's StormGuard Armor. It's a more sophisticated filter than the 20-month moving average. It uses 3 distinct variables, not just one. And according to StormGuard Armor, we've been in the S&P 500 index for last month as well. So here's the StormGuard indicator indicating that we've been in there since December 1st. And just to compare, you can always, this is a video, so you can always freeze this frame and take a look at data yourselves. But if you compare the S&P 500 index, if we were to buy, hold, and reinvest into a single mutual fund that tracks this index, versus if we switch between stocks and bonds using the 20-month moving average system, or if we were to switch using the StormGuard Armor system, I've highlighted in red all the years that we've actually lost money, compared to the black numbers where we've actually gained. So the benchmarks that are most interesting to me are when the markets lose money. Those are the days, or those are the years rather, that we see whether or not we actually perform as well or better than the markets, because it makes no sense to outperform the markets during the bull markets only, just to have even deeper losses during the bear markets. So if you take a look at the StormGuard Armor, it says that it lost 0.5% in 2015. Actually, if you were to do this by yourself, you probably would have gained 0.5%. It's just that these two columns, 20-month moving average and the StormGuard Armor, are corrected for fees. In other words, if you had a money manager doing this for you for 1% assets under management every year, you would have eaten away at that meager gains and had a meager loss for using the StormGuard Armor system in 2015. And then, of course, here's our year-to-date data. In all of these systems, we've been in the S&P 500 index all year so far. That's why the markets have been up 9.3%, but minus fees, we're only up 8.7% in these two systems. Here's the annualized results so far over the last 28.5 years. If you were to just buy, hold, and reinvest into the S&P 500 index, you would have gotten roughly 10% annualized return every year. You get a 1% increase in overall performance by avoiding the big bear markets using the 20-month moving average system. And then the StormGuard Armor, you have gotten 15% annualized over the last 28 years, which translates to, if you were to just invest in S&P 500 index fund, if you happen to put in $10,000 at the time, a good sized fortune back then, you would have ended up with $163,000 by now. If you use a 20-month moving average back then, and that means back in 1989 you would have gone to the library every month to look up all the old data in the newspapers and things like that, you will have ended up with 240,000, 50% more, for just a 1% difference each month. And if you use StormGuard Armor back in 1989, you will have gotten 3 times as much because of the 5% difference between S&P 500 and StormGuard Armor. Just a graphical version of the differences. So I'm giving you the 2 benchmarks. Here's the S&P 500 Index Fund. Here's the long-term Treasury mutual fund. If you were to switch between these two using the 20-month moving average, you will have gotten this green line here. And if you use the StormGuard Armor to switch between two, you've gotten this purple line. And the differences are so ridiculous, especially with the StormGuard Armor, that it's probably easier looking at this with a log chart. So this is a linear chart. So when things start to explode, it's hard to see the differences more objectively. So if you took a look at the exponential or logarithmic axis, remember, from here to here is 10 times, from here to here is 10 times. So even though we're up to 580,000, it's closer to 1 million on this chart than it is to 0. You can see some of the nuances and the differences in performance between these two systems better with the logarithmic axis chart. Now our next system is the monthly rotation investment system, something I abbreviate to MRI system for my book. For this system, there are 2 rules. Every month, rank these 3 particular funds, the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. See which ones did best, which ones did worse. Sell the bottom 25% of your portfolio and buy the top fund with the proceeds. So here's how this works. Last month's end of month data, this month's end of month data. Divide, divide, divide. You see that there is a winner. It is the emerging markets, but the difference between the two, 0.18% versus 0.19%, that's so small. In fact, if you take a look at graphical version, they're neck and neck. If I just saw the graph, I wouldn't have been able to tell which one was winning. So technically, if you followed strictly by the rules, you would switch into the emerging markets with a quarter of your funds right now. If you wanted to save commissions and slippage by just staying with what you had last month, because these numbers are so close together, I can't fault you for it. It's not strictly adhering by the rules, but this is one of those very few times when investor discretion may actually help out. Maybe. So last month, we were 1/4 in the S&P 500 index, 3/4 in the emerging markets. If we sell the bottom quarter, which is the S&P 500 index, and buy the top fund, which is the VEIEX, we are now 100% in the emerging markets fund. And here's sector surfer rotation of these 3 funds. I'm not using StormGuard Armor or anything, it's just a straight rotation. And according to Sector Surfer, we've still been in the S&P 500 Index Fund, not the Emerging Markets Fund. Remember, these are 2 completely different systems using the same 3 funds. So, just to compare head-to-head, buy, holding, and reinvesting S&P 500 Index Funds versus using the 3 funds rotating with the MRI system versus rotating with the Sector Surfer system. Again, these 2 columns are corrected for any fees, especially if you were to use a money manager charging 1%. This is if you just bought, held, and prayed and reinvested. We only go back to 1995 because the inverse fund only goes back to 1995. That's all I can do. But if you take a look, the annualized return, 9.48% for the S&P 500 index over the last 22 years, versus 11% following the MRI system, versus 15% for the Sector Surfer system, with a hypothetical $10,000 investment back in the beginning of 1995, you may have made $80,000 with the S&P 500 index versus $114,000 with the MRI system versus $257,000 with the Sector Surfer system. So here's a graphical representation of comparing the 2 systems. You can see where one system was weak compared to where another system was strong and vice versa. if you take a look at our three funds, we have the S&P 500 index here, the emerging markets here, and the inverse S&P 500 index here. The differences are so great, especially since one did so well and one did so poorly, going to the negative zone, that again, it's probably easier looking at this data using a logarithmic or an exponential graph, like so. So here you see how the S&P 500 index goes up, the inverse fund goes down, and vice versa. And then you can see how the sector server fared versus the MRI as detailed in my book. Again, between these two graphs, it's easier to see nuances better with one graph versus the other. So observations of this month with the MRI system. The markets have been very flat this month, with less than 0.2% growth in either the S&P 500 or the emerging markets. There's practically no difference between two markets at the end of the month. So a strict adherence to rules would rotate back into emerging markets for this month. And then Sector Surfer still has not triggered any switch from the S&P 500 fund. So remember, they're different systems. Don't mix up the systems. So the next system, we're going to review the rules for the 25% trailing stop loss system. I did go over this system in a little bit more detail in my December and January 2014 videos. I'll make sure those are available for you publicly on YouTube so you can look them up. But for the 1% risk trailing stop loss system, this is what we use for if you really want to buy an individual stock for some reason. Try to limit risk from that one stock to only 1% of your portfolio or trading account. So how this works is if we had a 25% trailing stop loss order for that one stock, that means you can buy with up to 4% of your trading account that one stock. You immediately put in that 25% trailing stop loss order, and then if the stock goes up, the trailing stop loss automatically goes up. If the stock goes up 33%, you can go ahead and buy another block of stocks because this trailing stop loss order has now hit break even. You really have no large risk unless the stock suddenly gaps against you. So go ahead and buy with another 4% of your account, another block of that stock, and update your stop loss order to reflect the increased number of shares. Keep doing this until you're stopped out. So the next system is your own Sector Surfer system. If you're subscribed to Sector Surfer, you have your own systems. I can't tell you what's going on in your system. The Sector Surfer website will email or text you when a signal is generated. The Sector Surfer system is another way to improve on classical pie chart investing if structured correctly. Basically, Sector Surfer has two main components. First, it has a filter, in this case StormGuard Armor, which acts like my 20-month SMA system, trying to differentiate between relatively dangerous and relatively safe phases of the stock market. And then, during those different phases, we can use sector rotation to use bull market funds during the stock bull market phases, and then bear market funds such as inverse funds or bond funds to trade during the bear market phases. We can combine these two systems into Sector Surfer because we've been backtesting to make sure that the system worked. Remember, you can't just haphazardly include systems together and trying to figure out how they work. You have to at least backtest to make sure it worked before. Now, past performance doesn't guarantee future success, but at least you can also see whether or not it even worked in the past. If it hasn't, get rid of the system. So Sector Surfer will send you signals through email or text. Now, the reason I say log on periodically, not because I don't trust Sector Surfer, I do. It's just that my own email system is very aggressive, let's say, in weeding out spam, and sometimes Sector Surfer does end up in spam, and I don't realize the signal has been placed until I actually check the spam folder, which is bad. So that's why I personally log on to make sure that I don't miss any pending trade signals. And now that I'm investing for clients as well, it's very important that I do this more regularly, such as once a week. And since this is what I do, this is what I tell you what I do, or this is something you may want to mirror with me as well. Now, when you do sign up for Sector Surfer, they do have a set of free strategies. So rather than following along with one of my own strategies, there shouldn't be any problems with me at least following along with a free strategy that they include with your free account. So before we go on, we know that Sector Server is telling us that right now the free strategy still remains in the safer stock zone and still stayed in the Fidelity Worldwide Fund as a stock fund of choice for continuing this month. So no changes yet. Here's our graph showing how just trading 5 times a year with this particular free strategy gets around 15% per year for the last 29 years. If you like this strategy, go ahead and use it. I can build better strategies based on what I understand about some of the strengths and weaknesses of Sector Server, and these things are very easy to learn. In fact, a lot of it's included in Sector Server's own videos on how to construct your own portfolios. But yet, this particular strategy, if you like it, great. If not, there are ways to improve on it. It's just that if you do improve on it, you will have to subscribe $10 a month to it. So the next system I'll review is the Dalio All Seasons pie chart. This particular pie chart was first introduced by Tony Robbins in his book Money Master Game back in 2014. Their theory behind Dalio's portfolio construction is based on completely different criteria than what traditional money managers use. But bottom line is we end up with this particular pie chart where you use 30% stocks, for which I'm using the S&P 500 Index Fund, 15% intermediate term treasuries, which I'm using this particular Vanguard fund, 40% long-term treasuries, in which case I'm using this particular Fidelity long-term treasury bond fund, gold, which I'm using the GLD ETF, and commodities, I'm using the DJP ETF because Vanguard doesn't have ETFs or funds for these particular asset classes. So here's the chart so far. If you compare the S&P 500 index component with the intermediate term treasuries, long-term treasuries, gold, commodities, here's the Dalio pie chart year over year. I've highlighted in red again all the years I actually lost money. So far this year, the portfolio is up 6.5% compared to 9.4% for the S&P 500 index and 7% for long-term treasuries and gold. Commodities, if you look at from a traditional money manager aspect, it's lost money in so many years that most people would not include commodities in their portfolio. Some traders may use it if they can detect changes in trends, but in the case of Ray Dalio, because of the particular theory he uses to construct this particular portfolio, it's actually helped stabilize his pie chart over time. So here's a graphical representation of his pie chart. All the various components, including stocks here and commodities down here. This black line is our fairly smooth line. It rebalanced every year. So know if you're in Dalio's pie chart right now, the model does not say to touch it right now. It just says at the end of the year, rebalance. It's not the end of the year yet. So this black line would be Dalio's pie chart, and it's done about as well as the long-term treasuries, with a lot less volatility. So in summary, remember, I've reviewed many different systems. Each one has their own rules. Do not mix up these systems. Now, the possible exception would be Sector Server, which we actually use 2 different systems together. You can use Sector Server without StormGuard Armor, but for certain instances, you may want to combine StormGuard Armor with Sector Server. I've reviewed the 20-month moving average system, the MRI system, dealing with stock tips, monitoring your Sector Server strategies, and had a little update on the Dalio All Seasons portfolio. So questions, keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me to set up a consult. A few of you I've talked to, you know your stuff. I'm fine with you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So until next month, invest safely.